Now, let me first introduce our first presenter. Elikia Abraham is an infrastructure financing specialist at the World Bank, where she oversees the Public-Private Infrastructure Advisory Facility, PIAF, the portfolio for East Asia and the Pacific region. And at the same time, she leads the PIAF's local currency finance program, which is very appropriate for the conversation we are going to have today. Our technical areas of expertise are in infrastructure investments across diverse sectors with a focus on transport, climate change, and private capital mobilization. Elikia is joining us from Washington, D.C. So, Elikia, you have your presentation. Thank you very much for joining us so early. I know that it's 6 a.m. In the morning in Washington. So thank you. We want to hear about your recent study on long-term local currency finance. Thank you.
Thank you so much, Eddie, and good morning, good evening, and good afternoon to all participants in the first workshop on this how to deal with inflation, exchange rate, and interest rate in PPPs. As Eddie mentioned, I am an infrastructure specialist based in Washington, D.C., working specifically with the Public-Private Infrastructure Advisory Facility. To share a little bit about PIAF, PIAF mandate is really to support clients to strengthen policy, regulation, institution, pipeline development, and identifying financing options that enable sustainable infrastructure with private sector participation. As Eddie mentioned, I am the portfolio coordinator for PIAF in the Asia region, and I also oversee our activities when it comes to long-term local currency financing. To give a little bit of the background of the report that I will be presenting today, this is part of a 5 years period program launched in 2022 by the Public-Private Infrastructure Advisory Facility of the World Bank Group. And the objective was mainly to support developing economies to further deepen their local capital and credit markets, and as well expand their offer of local currency finance for climate and infrastructure projects. It's also important to mention that the program has twofold objective. One is this global analysis that I will be presenting today, and that was developed in partnership with different World Bank Group practices, including the World Bank Group Guarantees team. And I will be joined later on by my colleague, Caroline Lutongolo, who is a senior infrastructure specialist with the World Bank Guarantees team platform, to further discuss some of the instruments that have been deployed by the World Bank to support lending in local currency finance. This also has been prepared with the partnership of the Joint Capital Market Program of the World Bank Group, specifically mainly championed by IFC and the Finance Competitiveness and Innovation Practice. With this background, let's move on directly a bit into the content of this analysis. I will discuss first the obviously importance of local currency finance as another solution to finance infrastructure projects, as it is a natural hedge for infrastructure and PPP projects. Then perhaps talk through a little bit the constraints and opportunities for lending in local currency. Moving on into what we call the local currency diagnostic framework that was developed to help countries assess their readiness and areas of expansion when it comes to looking at local currency finance for sustainable infrastructure. It's good to mention that this was based on 2 case studies of advanced local currency markets, meaning Malaysia and South Africa, that I will be presenting. And after developing this local currency finance diagnostic framework, we applied the framework as a pilot to 5 sample countries. And I will be showing what were the results in terms of what we identified could be the binding constraints in the case of more developing markets, and what are the enablers for more advanced markets when it comes to lending in local currency. And then we derive from this some form of policy recommendation and some country-specific targeted recommendation when it comes to moving on into deepening local currency finance markets. So I will start now with a bit of the rationale and the background. As we all know, a recent study published by the World Bank Group on the impact on global events on infrastructure financing showed that COVID-19, and you can see from the figure 1, the Ukraine war, the rise of interest rate have left countries to the need to find alternative solutions to lend in local currency. And obviously, COVID-19 led to a level of public indebtedness that led countries to the necessity to rely on more local markets versus hard currency and depending on financing from DFIs. We've also seen on the figure 2, you will notice that there's been a rise of interest rates, obviously by central banks that have been impacting the construction costs of PPP projects. An analysis even showed that in almost 18 months, there's been an increase of by 20% of the construction costs between December 21 and June 2023. This therefore poses the question of how can we deal with this issue of currency mismatch, meaning off-takers need to convert local currency revenues into foreign currency to make their payments, assessing the host country's FX reserves. So there is a need to hedge this currency risk, and local currency presents itself as a solution because, one, it shields the economy from volatile capital flows. It reduces the burden of hard currency repayments, and is also allowed to tap into new capital sources for development. Other advantages that need to be highlighted when a bank considers lending local currency, it also improves their credit evaluation skills and also help address what we will discuss later on as what we call the asset liability mismatch. You will see from this graph figure 4 shown on the screen that there is a broad spectrum when we started looking into how practices in developing markets and advanced market when it comes to lending for infrastructure projects. You will notice that low-income countries tend to rely more on FX-dominated debt from DFIs versus advanced markets are able to rely on capital markets to actually lend in local currency. And two main obstacles have been identified and explaining the reason why developing economies rely more on FX-denominated debt. The first one is the lack of ability to provide local currency loans. And this is also linked to the lack of hedging instruments or even very high domestic interest rates. The other constraint that we have identified is the ability to actually provide long-term lending. And we often discuss this issue of banks only providing very short-term length of tenors versus actually the requirement of infrastructure projects that require longer tenor, 10 years and plus. Another constraint is even more emphasized by the Basel III reform that lead to this issue of having a certain level of banking reserves and an issue of asset liability mismatch, meaning short-term deposits versus long-term liabilities. And therefore, in this context, and I'm moving on some of the first slide because we all know we've developed this local currency ecosystem analytical framework that you can see on the screen. While it seems to be very complex, to summarize, it's basically discussing the supply of finance coming from capital markets, credit markets, and showcasing all the different players, market players, whether it's definitely the government bond markets, corporate and project bond markets, or even more different financial intermediaries like National Infrastructure Bank, Green Finance Bank, and commercial banks. And the underlying idea is that in the best case scenario, this is what the country should aim to reach. Meaning first, when we start from the top to the bottom, there needs to be a stable macroeconomic environment with very low inflation and interest rates, which we're discussing today, high growth and employment, and a certain level of fiscal headroom. The report, as you will see later on once it's published, discuss some of the policies that will foster such stable macroeconomic environment. But first, let me pause and explain why this is very important as an underlying environment that will foster the ability to tackle the FX risks, real interest rate risk. First, low nominal and real interest rate help making borrowing in local currency more competitive than FX. Which is also one of the main constraints we have discussed before. High growth rates increase affordability of infrastructure projects and also allows more long-term savings to be used as a means to finance infrastructure projects. Low inflation obviously enables low interest rates, as we discussed. This seems to be very obvious, but they're the underlying sometimes constraint for advanced transaction or the use of hedging instrument like the one that will be discussed with TCX. There's obviously also the issue of the fiscal headroom that can allow countries to deploy credit enhancement instruments that we will be presenting later, such as guarantees, or even use viability gap funding. The second, as we move from the top to the bottom, there is this supply of finance from institutional savings, capital, and credit markets. First, when you look at institutional savings, we've noticed that in some countries like Malaysia and South Africa, there is a larger base of institutional investors that can provide financing that meets the requirement of tenor of infrastructure projects. And therefore, these long-term savings, where capital or credit markets are well developed, they can be intermediated into infrastructure projects and PPPs, therefore bypassing the issue of asset liability mismatch that we have been discussing, because these are long-dated assets, and therefore they can match the tenor requirement of long-dated liabilities, which are infrastructure projects. Moving on then into from the top to the bottom, capital markets. There is a need to have an established yield curve that can facilitate, that can be facilitated when government issue regularly bonds. And as well, there's a foundation that needs to be set, meaning the development of long-term interest rate swaps markets, the like of which will be discussed by TCX. Moving into credit markets, there is the role of local banks that we will discuss in the case of South Africa, that can, when they have very stable deposits rates, they can therefore bypass the issue of asset liability mismatch and provide long-term lending, even by accessing long-term bond markets. I will finish by discussing on this slide, you will also see the role of alternative financing vehicles, such as private equity funds, special infrastructure funds, that serve also as an intermediation of DEF, which we oftentimes call pool infrastructure financing, that manage to also address the issue of risks because they have very in-depth and advanced project evaluation and credit evaluation skills to structure projects in a way that can enable to lend in local currency, or even bypass the FX risk or the currency risk or exchange risk. This is all channeled finally into our target. As you see, there is this red box, the discussion, which is the target of our discussion today, PPP projects. And when discussing with bankers and market players, oftentimes the issue is not necessarily the supply of finance, but we've noticed the issue is the availability of affordable project, bankable project, and therefore there's a role that the government needs to play when it comes to providing a predictable and trusted legal and regulatory environment, incorporating at very early on stage local currency in project design, and providing programs of investment opportunity that ensure that there is a clear project pipeline and facilitate private sector participation into infrastructure projects. And all this I will highlight through two examples. So the case first of Malaysia. Malaysia, contrary to South Africa, the expansion really of local currency markets has been driven by capital markets and also a very stable macroeconomic environment. The government very early on has put in place policies of regular bond issuance that help establish a yield curve, which we discussed earlier, and gave therefore a benchmark to price to provide a pricing on bond markets that will serve as an enabler to channel institutional investment into infrastructure projects. Very early on, also the government of Malaysia have put in place compulsory retirement savings, therefore increasing their institutional investor base. The government has promoted transparent and competitive public-private partnership as a means of facilitating private financing, particularly in the transport sector. They've used PPPs for toll roads to accomplish its highway expansion objective, and therefore intrinsically supporting the development of local currency finance. I will highlight one last feature of Malaysia is the large-scale solar program that provided a competitive bidding process to award PPAs to large-scale solar projects. Now, moving on into South Africa. South Africa, in a different way, the depth of local capital markets has been driven by banks, with very advanced skills to structure projects. And one thing to highlight is the Renewable Energy Independent Power Producer Program that has been a critical enabling policy in developing a pipeline of infrastructure projects that are local currency finance friendly. And how have they done so? The program, the REIPP, the Renewable Program of South Africa, in the request for proposal process, they use non-negotiable PPA, which specify that every single transaction needs to be denominated in rand. And also these transactions are being backstopped by the Treasury to facilitate private sector participation and private sector integration into the grid. This has been really driving the lending in local currency, specifically for in the energy sector. Finally, in 2022, South Africa government has removed regulation that prevented pension fund and institutional investors to participate directly into infrastructure projects. So when we apply this framework and using the example of South Africa, we identify 5 key enablers that country need to consider when they want to decide, they want to deepen their local capital markets or local credit or local capital markets. First is the need to have a sufficient scale of what we call contractual saving, meaning the availability of pension funds, provident and insurance fund that meet what we discussed earlier, this long-term tenor requirement for infrastructure project. And on the figure 6, you will see that Malaysia and South Africa have very highly developed the financial sector with the highest level of bank deposit and insurance and pension fund assets that have mainly been driven by this policy that I mentioned in the beginning of compulsory savings, retirement savings put in place by the government. The second enabler binding constraint in some countries is this ability to provide long-term debt, meaning in some countries, for example, like Indonesia, their financial intermediaries like the Indonesia Infrastructure Finance Facility enable when banks issue a debt of 5 years, a long tenor, they're able to roll over and extend the length of the tenor beyond even 10 years. So these are some of the processes that have enabled them to deepen the local capital market, hedging naturally their exposure to FX risk. The third enabler and binding constraint is the ability, as we discussed, to establish a yield curve that can enable countries to access bond markets where local banks are not able to provide the length of tenor required for infrastructure projects. The fourth one is related definitely to this interest rate, when sometimes domestic interest rates are so high that intrinsically FX lending in hard currency is more competitive than lending in local currency. And the last one, thinking again at the example of South Africa, is the ability to have credit evaluation and structuring skills to access, for example, more advanced hedging instrument to the like of interest rate swaps that we discussed before. Based on this, we have developed what we call the local currency policy intervention framework that gives high-level guidance, first upstream to downstream, looking towards the spectrum of credit, capital markets, and other sort of intervention when country wants to consider local currency as an alternative solutions to finance infrastructure projects. Moving from upstream to downstream first, the idea of promoting macro fiscal stability and deepening local currency markets by prioritizing developing money and capital market, increasing the scale and efficiency in capital allocation. Moving down again is the ability to raise more institutional contractual savings to the like of what we have discussed before, pension funds, perhaps putting in place policies that increase the investors base and the institutional investor base, like the example of Malaysia and South Africa. Moving then down, more downstream, putting in place what we call pool financing mechanism, like infrastructure funds, private equity funds that serve as an intermediary to channel institutional financing into infrastructure projects. Even more downstream, offering targeted credit enhancement solution to develop lending in nascent sector, for example, credit guarantee scheme, risk sharing facility, as presented in the case studies that we will discuss later. This will help unlock local commercial financing where there is an insufficient liquidity on the balance sheet of banks, but also will allow to lend long, what we call provide long-term financing. And on the other side, the specific one that we are discussing today is developing a fiscally sustainable local currency friendly PPPs, meaning looking at the design of tariffs that will help address this issue of currency mismatch, which has been done successfully in countries like in Kenya. I will highlight some few examples of what we have presented in the local currency policy framework. For example, pool infrastructure investment. This is the case of the Indonesia Infrastructure Finance Facility I have highlighted before. IIF, Indonesia Infrastructure Finance, was established in 2010 to provide long-term lending for infrastructure projects in rupiah. In IIF, basically, the state takes in IF, so the state has an equity participation as well as IC that enable them to lend without the constraint and the restriction that banks have due to Basel III reform. They are able to lend directly in local currency, tapping into bond markets and providing sometimes tenor that go beyond 10 years, as I mentioned before. A key feature to mention of IF is that most of their portfolio is in rupiah. 73% of their portfolio is in rupiah, therefore hedging them naturally from FX risks. They have also been able to tap into, to use credit enhancement facilities for PPPs. And over the years, PIAF and the World Bank Group have provided support to IF when it comes to deepening their offer, looking into sustainable infrastructure by helping to develop a screening tool for infrastructure, climate project, social project, and as well helping them to develop an equity fund. Another example would be the Cameroon Nightingale hydropower project. It's a World Bank guarantee, and this example is interesting because through the provision of a 200 million IBRD loan, and also through the provision of a 100 million IBRD payment guarantee, the government was able to mobilize local financing, so get private local banks to participate in financing this big hydropower project, about 420 million megawatt, 420 megawatt in this power project. And what is the underlying idea is that banks can exit either after 7 and 14 years this concession agreement. And therefore, the tenor that has been provided for this project goes up to 21 years. A last example that I will be presenting is the World Bank Risk Sharing Facility, which is a project that the World Bank provides to government to backstop credit and non-performance risk for local SOEs, financial intermediary, based on a pre-agreed portfolio, based on a pre-agreed portfolio of projects that aligns with the World Bank development goal. Oftentimes, it's energy efficiency, or that is one of the primary development goal of the World Bank Group. And what this risk, by providing this World Bank partial guarantee through the risk sharing facility, it helps to cover about 80% to 50% of the project risk, both of all these sub-projects, so on the pre-agreed portfolio. Finally, it's also good to mention that the World Bank's exposure will be leveraging over 3 times of the local debt from local financial institutions. So what is the way forward? And this will be my last slide. The way forward, we are developing currently under a program that we call the Sustainable Infrastructure Investment Program in Domestic Markets, a pool of tools that will operationalize this recommendation. All will be consolidated into a local currency toolkit, including guidance to projects, to markets players that are interested in participating in infrastructure in local currency, on financing instruments for project structuring, guidance on PPP legal framework and tariffs design. We will also develop a local currency pipeline screening tool. And all this will be disseminated through capacity building and knowledge sharing program. The last slide is really more so to show the span of the different spectrum of World Bank organization that will be participating in the deployment of all these tools, from upstream to downstream. PIAF sitting more at the upstream level, as I presented in the beginning, helping government over the past year. We've been helping government throughout the world to either strengthen the enabling framework, identify bankable pipeline of projects, managing the issue of fiscal risk when it relates to PPP projects, and building also the capacity. I also mentioned strengthening the capacity when it comes to identifying climate smart and social friendly projects. And more downstreams, you have our colleagues GIF, Joao joining today, the IFC, and then I mentioned also MEGA guarantees. We are joined today by my colleague, Caroline, that will be supporting and providing some answers to the question you may have. So thank you so much, and then back to you, Ede.
Elikia, thank you so very much. And let's get into a little bit of the conversation because your presentation was so broad and covered so many cases that I'm sure that there are lots of questions that the audience has. But let me start with a couple from my side. Because you talk a little bit about tools that are useful for low-income countries and others that are useful for middle-income countries and experiences like South Africa and Malaysia. When you look at low-income countries, what is your experience and advice on the first baby steps, the first initial steps that a country has where you don't have capital markets, where the banking system is very thin? What to do in that process? Is it the creation of an infrastructure bank that can help with steps when there's not much out there?
Thank you, Ede. This is a very good question in the sense that this local currency ecosystem framework that we have developed, it's a product that is available to country to assist them into knowing what is the first basic steps. And this is a little bit also an outreach saying that for countries that are interested in this, please do reach out to PIAF, because the idea is to see where you're standing. When you look, for example, at South Africa, they have a very advanced enabling environment, right? But when we discuss, for example, the case of Ghana, the best practice for them was to go through the Ghana Infrastructure Investment Fund, where they are still in West Africa, putting in place all these framework, building a local capital market, building local credit markets. So the answer is not necessarily, we're not necessarily promoting the establishment of new institution, but what we're saying is to leverage some of the existing instrument that the World Bank is providing. And I thought this was appropriate to bring the case of Cameroon. Because as you know, Cameroon does not have that advanced framework, but managed to leverage the instruments that are available, credit enhancement solutions that are being deployed by the World Bank Group. So in a nutshell, definitely leveraging the existing tool, like the credit enhancement facility, and perhaps enhancing the role because there are existing infrastructure institutions of which role can be enhanced using some of the support that PIAF has been providing, for example, to Indonesia Infrastructure Finance Facility, while deploying more of the long-term macroeconomic policy that we have discussed to deepen the ability of to enable institutional investors to channel savings infrastructure project like South Africa did by this regulation that removed the constraint for institutional investor to participate directly into infrastructure. Another example I didn't mention is the pension funds and insurers that do not have the same kind of constraints as the banks, local banks, and are able to lend directly into infrastructure, but then it requires deepening their credit evaluation skills, and that also is a support that the DFIs can provide, as we've been doing in the past. So
I'd like to build on that. You mentioned that it's important to have an intermediation services when pension funds or savings funds don't have that expertise to understand the process. What kind of services are those? What have you seen that works well? Is it a new institution? Is it a unit within that organization? Is it hiring a group of consultants? What does it mean, intermediation services?
Thank you again, Edi. And I think it's again an outreach that I'm going to do here by saying, please do reach out to PIAF and the World Bank Group. For example, we've been working, when it comes specifically to insurers, we've been working with our partners, the PIJ, who have recently deployed what they call infra credit. Basically, it provides a credit enhancement, an instrument that enables them to channel fundings from insurers, develop projects, assess their bankability, structure the project, and then lend directly into infrastructure projects. So I think there's existing infrastructure, existing instruments that can facilitate that. And that's what PIAF is proposing, to consolidate all this information in one toolkit that will be directly applied by countries. But the first step, I will say, is to reach out to institutions like the World Bank, because currently, for example, we're working in Nigeria. It's not about setting a new institution, but opening maybe a fund or an equity fund within an existing institution that will help to actually invest in infrastructure project, not just in debt. Sometimes it's not possible to do in debt, but also taking a participation in equity in projects. So there are different ways, and depending on the context that we've been doing this.
I'm bringing one of the questions from the chat, and which links to something that you mentioned. There may be cases where, let me take a step back. The usual answer to many of these risks is to say, oh, you need to go to the local currency. But there are specific risks also linked to local currency. You were talking about where the interest rates were so variable and changing so much that actually it was far more stable to go into foreign exchange. Can you tell us a little bit more about the differences, and what do you see as important risks when you're looking into local currency financing and how to deal with them based on your experience?
When we look at, for example, interest rate risk, and I'm sure the colleague from Egypt will be presenting this, we've seen cases where the government has chosen to go through interest rate subsidies. It's been the case in Malaysia, or other ways is to go through TCX, when actually bond markets are actually more advanced. But you need to have a yield curve. And the issue there is when there's no yield curve, you cannot tap into interest rate swaps. So what we've seen in the past is, in more cases, more countries will go with blended finance, where you have a portion of concessional finances that comes in and enables to first start the project construction, and down the line, bringing private sector or using other instruments like the guarantees to provide more financing for the project. And in essence, it helps at many levels when it can be going through very complex structuring, but to make something complex very simple is basically using the skills like the World Bank Group, like the colleague of Caroline that is online, and maybe she can also share some example that she has been seeing in countries where she's been working, is using the existing instrument tool, viability gap funding. We've discussed recently more hybrid, other instruments like hybrid PPPs, where it's not just foreign hard currency that is being used, but there can be a hybrid where you have foreign currency and also local currency. So I think it's more a question of project by project, case by case, in terms of deciding of the design. But maybe I would like to would you like to invite Caroline?
I would love to invite Caroline to talk a little bit
Yes.
about the perspective from the guarantees. How do guarantees come into this landscape of interest rate risk and other risks to be able to make some of those projects viable? Caroline, would you like to say a few words?
I'm going to be very brief because I have a conflict in my agenda, but I just want to say, from the perspective of guarantees, there are two things I would like to emphasize that my colleague already touched on, which can be helpful. And the first is using what we call risk-sharing facilities, which are just essentially a way through which the bank comes in to support publicly owned banks to extend the ability of those banks to provide a credit to portfolios that capture areas of significance or corporate priorities for the World Bank, such as renewable energy and energy efficiency and so on. And just to flag that, although the facility of the bank, so essentially what the World Bank does is to come and say, given that the major risk that many of these banks face is the credit risk on the part of their borrowers, and this inhibits the ability of those particular banks to be able to provide affordable facilities with acceptable tenors to borrowers who can advance these important topics, particularly if you're looking at things like energy efficiency in nascent markets. You know, there's an additional risk that is associated with that profile of borrowing. So the bank comes in to share the risk at the level of the intermediary banks. So while typically the bank provides its facilities, its guarantee facilities, you know, in hard currency, mostly in dollars, we can cover local currency risk of the intermediary banks lending to the, to their domestic borrower profile, because it's typically domestic clients that will be, or customers that they'll be lending to. So that, pushes the envelope, because it's, from the perspective of the bank, our products can either cover the first layer of risks or the second layer of risk. We can structure the facility in different ways. Sometimes, our intervention can also be through a funded product, so not necessarily the guarantee, but you can also provide funded products to further capitalize those state-owned banks, or to further also provide an intermediary institution that specifically bears the credit risks. So we can actually capitalize another institution. So that's one thing. And the second one is
Caroline, I am so sorry to cut you short, but we want to make sure that we have ample time for the others. May I suggest that you put in the chat room a link where the audience can follow up on your very interesting products and learn some of the examples on that process. We have big thanks for us for your intervention into this process. And a big thanks to Elikia for a very detailed presentation in that process. And if you can share the link of the report when it's available, we will share with everybody who is connected into this process. Karen and Elikia, thank you so much for joining us.